with the time of the year that's in it, today I wanted to go through with you a checklist for the actions you must and should take before the 31st of December 2025 to maximise your tax benefits and to not only maximise those benefits for this tax year, but to prepare properly for tax benefits in the coming years. I want to tell you a number of things to do, and I want to start talking to business owners initially about clearing out your profit. Why would you clear out profit? Because, now, of course, companies need to make profit and need to have a float, and you need to ensure that the cash flow of the company is right to not kill the goose that's laying the golden eggs. But beyond that, and certainly I have anecdotal evidence through the company owners I'm meeting on consults, these company owners, many of them are carrying very large undistributed profit. And what's the problem with that? Well, let's just look at 2025 for a second. Let's say you're making €100,000 profit. And you go, well, okay, I leave it in the company. I pay just 12.5% tax, corporation tax. And that is true. So about €12,500 of the 100 grand, puff, goes up in smoke and goes to the corporation tax division. Now, that's not the only tax you pay. Because if those profits are not distributed within 18 months of them being earned, you're also going to face a withholding tax. You're also going to face what is called the closed company surcharge. A closed company, by definition in Ireland, is a company owned and controlled by 5 or less shareholders. Most of the company owners I'm meeting, they have 1 or 2 shareholders at most. So they're all closed companies in that respect. Closed company surcharge is a 20% surcharge on the retained profit. So go back to the 100 grand you're making in 2025. 12,500 of that is disappearing to the corporate taxman. But 18 months later, 20% of the 87.5% you've retained after tax, that's going to the taxman too, through the closed company surcharge. That means that the actual tax rate on profit is 29.6% when you include the closed company surcharge. So that's the reason to strip out profits. How do you do it? You do it through extra salary and bonuses, perhaps, making sure you're eating up your own tax credits, making sure you're eating up familial tax credits, assuming that applies, making sure that you're making contributions to your retirement scheme, which I'll come back to in a minute because I want to deal with that as an individual subject, making sure that you are paying SBE, the small benefit exemption, 1,500 quid per employee, tax-free, making sure subsistence allowances have been claimed properly. These are the daily tax-free amounts that can be paid to employees. And don't forget, business owners, you're an employee most often than not of your own business. This is 1,500 quid a year for you, for your spouse, for your children, if they're all on the books of the company. The other thing is, that's SBE. Subsistence allowances, as I say, they're the daily amounts, tax-free amounts, for having to be away from your normal place of work on the company's business. Finally, increasing salary even beyond tax credits can be beneficial. And I know that sounds counterintuitive, but the reason it can be beneficial is there are extra allowances because of increased salary. Something like EIIS. So let's say you declare yourself a bonus of 50 grand. You say, oh, for goodness sake, Paul, that costs me 25 grand in tax and levies. And that is true. But having declared that bonus, if you put that same 50 grand into an EIIS, depending on the type of EIIS, you can get that 25 grand back. Now, there is a cash flow cost here. You make the investment now and you claim the tax back in your 2026 returns. But there isn't a tax cost when you put the money into EIIS. The other thing that can be done is company-sponsored pension contributions, be they PRSAs or master trusts or any other type of company-sponsored scheme. The amount that goes into those schemes is dictated in part, at least, by your salary. So the bigger the salary, the bigger the amount that can go in. So let's focus on one of these things. And I want to focus initially on SBE. SBE, as those of you who've listened to me before know, is small benefit exemption. And despite the fact that this being on the statute books for a number of years, I am often surprised at how few business owners are using it to its maximum advantage. So, at its core, SBE allows you to give every employee up to €1,500 in a tax year and have it tax exempt. Now, what that means is it can't be cash, it can't be redeemable for cash, but it can be, for example, a prepaid card. Either a voucher for a card for a store in particular, or a card like One for All that covers multiple stores, or indeed a prepaid MasterCard which covers every store in the country that takes MasterCard. So the €1,500, as I say, is tax exempt. If that €1,500 had been paid to an employee taxable, the tax liability on that is €780. So whether you're an employee or an employer, if you're an employee, point out to your employer that there's a more tax-efficient way to pay you a Christmas bonus, for example. If you're an employee, recognise that there's a more tax-efficient way for you to pay that bonus. Because as an employer, not only does your employee benefit, in this case saving themselves £780, but you also save yourself, because SBE is not chargeable to employers' PRSI. Employers' PRSI on £1,500 is €166. So the cost of paying a €1,500 bonus without using SBE is €780 in tax to the employee, €166 in PRSI payments to the employer. That's a cost of €946. The cost of paying the £1,500 through a prepaid MasterCard is a 2% charge plus VAT, a total cost of €36.90. So €36.90 versus €946 in costs. I know which one I'd want, I know which one you'd want as an employee, and I know which one the employer wants because of the 11.2% PRSI saving. That's SBE. Now let's talk about pensions. And I imagine some of you might be rolling your eyes. Here he goes again talking about pensions. But I talk about pensions because they are such a wonderful tool to reduce tax liabilities. So let's talk to employees first. You have various allowances called AVC allowances, additional voluntary contributions. They range between 15% of pensionable salary up to 40% of pensionable salary, depending on your age. The point here to make is that no matter what age you are, if you're a top-rate taxpayer, you can put if you put €100 into an AVC, the cost to you is 60. As I've said before, if I racked up to your front door and offered you £100 for £60, you'd bite my arm off for it. Not only would you buy one, you'd ask me, do I have another £100 I could sell you? Now, there is a price to pay for putting money into pensions, is that you can't spend it down the shops next Tuesday. You're sending money through a tax-free funnel, effectively to future you. But with a €60 cost for 100, that's a 66% return in a day. The cost of 60, the amount is of 100 in new wealth retained. For business owners, even increasing your salary might be worth it, because allowances, your company's allowance for contributions to your company-sponsored retirement scheme is dependent on salary, or at least partially dependent on salary. It's dependent on age, it's dependent on term to retirement as well, it's dependent on back service where you didn't have a pension or you didn't maximise pensions. But I was doing a number this morning just to give you an illustration for a business owner on 70,000 a year as salary. Broadly speaking, based on that salary and their age and their years of service and term to retirement, the salary allowed a once-off contribution of about 100 grand into the retirement scheme and an annual contribution of about 50 grand. As I showed them, if they increased their salary to 115,000, which is the maximum pensionable salary under tax relief rules, while that would cost them about 26,000 in extra tax and levies, the lump sum moved from 100,000 to 200,000 and the annual contribution moved from 50,000 to about 85,000 euro. So electing to pay 26,000 odd in extra tax meant 100 grand more in a lump sum and a doubling effectively, or close to a doubling of the annual contribution allowed. It sounds counterintuitive, but at times as a business owner, it pays to elect to pay more tax because retirement funds allow you to move more than the tax you pay into the tax-free bubble that is your retirement fund. Let me add just one more thing when I'm talking about pensions. And hopefully it's obvious with the examples I've given you. I'm talking about AVCs for those employed by major businesses or indeed smaller businesses. And the reason those products are suitable for you is, typically speaking, the fees and charges of those products are paid by your employer, which means that you will get a far better deal doing AVCs with the incumbent pension scheme than you would going and buying them off the shelf on the high street. Where employers are concerned, what I've been talking about there is what is called an executive pension scheme. And the executive pension scheme's limits are based, as I said, on age, salary, years of service, past use of allowances and so on. What I haven't yet mentioned are PRSAs. And PRSAs, often for business owners, especially for younger business owners, allow greater payments in than the executive pensions, because PRSA's contributions are limited to 100% of salary. Now, because I'm an old man, my pension fund allows me much more than 100% of salary, and therefore the executive pension route suits me. If you're a younger business owner, it's unlikely you'd have the allowances that I have because you're not as old as me. And therefore the PRSA maximum of 100% may well be the most suitable for you. I suppose the point here for business owners is, don't just go willy-nilly into the vehicle you have. Check the options, talk to an impartial advisor, and make sure that the retirement scheme you use, which lowers your taxes, which lowers your commercial risk, which increases your personal wealth, that you use the right vehicle for you. The next thing I want to talk to you about is subsistence allowances. And broadly speaking, the title of subsistence allowance covers mileage, and it covers the daily rates of subsistence that are allowed for an employer to pay an employee when that employee has to be away from their normal place of work on the business of the company, of the employer. So let's talk about mileage first. Mileage relates to you providing a car to your employer for business purposes. And there are a number of different mileage claims you can make, depending on the size of the engine of your car and depending on the length of the kilometres you drive on behalf of business. And rather than go into each and every one of those, let's talk about the maximums. The maximum engine size is 1500 cc's or more. And where that engine size car is concerned, the minimum per kilometre claim you can make is 25.87 cents per kilometre. The maximum is 90.63 cents per kilometre. The minimum refers to a huge amount of mileage or kilometerage in a year, 25,000 plus. The biggest rate refers to about between 1,501 kilometres and 5,500 kilometres. But this is your money, guys. Whether you're an employee providing a car to your employer, or whether you're an employer being an employee yourself of your own company, these are legitimate mileage written in the statute books of Ireland Inc., and you should be claiming them. Moving on from mileage, there is also broadly subsistence, daily subsistence allowances. And again, there are various different rates here, depending on the hours away from your normal place of work. If you are 5 hours, between 5 hours indeed and 10 hours away from work, the allowance is €19.25 in a day. If you're more than 10 hours away, the allowance is $46.17 a day. And if you're 24 hours a day, the maximum allowance is €205.53 per day. These are unvouched subsistence allowances, which means you don't have to produce receipts. What you have to produce is a work diary showing a log where you have been away from the normal place of work for the various hours for which you claim. Where the top rate is concerned, the 205.53, is important to say that that's only available for the first 14 nights in a given tax year. If you're 14 nights plus, the rate drops to $184.98, and if you're 28 nights away plus, the rate drops to $102.76. But bear in mind, as I said already, these are unvouched. There's no receipts necessary here. There is a log that you keep and that you use to back up your claim. So, broadly speaking, if you were skiing off the top of the mountain here, if you were able to claim maximum mileage rates, if you were able to claim maximum 5-hour rates and 10-hour rates and 24-hour rates in a year, the ultimate payment is in and around €16,000 a year. Now, I'm not suggesting for a moment that you pad these expenses. I'm not suggesting for a moment that you pretend you were somewhere when you're not. That it would be illegal, and that would be basically revenue fraud. But what I am suggesting, and again anecdotally by the clients I meet on consults, many of you, being employees or employers, are missing these allowances year by year. Get in touch with your accountant, and if you're an employee, get in touch with your payroll people. Make sure they're aware of these allowances and make sure you're claiming them to the maximum extent possible and legitimately allowed. And I suppose I should have said it already, but make sure you do this before the 31st of December 2025, because you can only claim these rates for 2025 in 2025. The next thing I want to put on your checklist, as it were, is capital gains tax. Now, capital gains tax is treated quite a bit differently than income tax or incorporation taxes, in that gains made between January and the end of November in 2025 are the taxes due on them by the 15th of December. So now gains, of course, where capital gains tax is concerned, are based on disposals. So you've no tax liability if you bought something on the 1st of January 2025 for €1,000 and it's valued at €5,000, lucky you, on the 30th of November, because you haven't sold it yet. But if you have liquidated a gain in that period of time, the tax is due on the 15th of December. And not only is it due on the 15th of December, but if you don't pay it by the 15th of December, penalties will automatically apply, which means that the tax liability rises by 8% a year or by about 0.02% a month. So make sure you declare your capital gains and pay the amount. Now, you might say, well, I haven't sold anything, but there might be a reason why you should sell something, or at least partially sell something, because of the annual small gains allowance, which is €1,270. So every year you can make a €1,270 gain and have that tax exempt. Now, where does the 1270 come from? Well, believe it or not, it comes from 1999, because the allowance in 1999 was £1,000, and £1,000 is €1,270. Yet another example of allowances failing to keep up with inflation. This is a 26-year-old allowance, and while it was sizable perhaps in 1999, it's far less sizable today. But it's still worth considering. So have you made a 1,270 gain somewhere? Would you like to be sure that you pay no tax on it? Then you need to dispose of that asset, and you need to pay, to get the 1,270 claim against your capital gains tax liabilities for 2025. The other thing to talk about where capital gains tax is concerned is what is referred to as tax loss harvesting. So let's say you have a portfolio that you paid $50,000 for on the 1st of January, and that portfolio is worth $40,000 today. Now, if you do not sell that portfolio for the $40,000, that loss is not counted for tax purposes. If you do sell it, you copper fasten the loss. And the one silver lining to losses is that they can be carried forward. Often known in the business, this is bed and breakfasting, where you sell a particular stock either to copper fasten your 1,270 tax-free gain, or indeed to copper fasten your losses, because those losses can be carried forward into the future and offset against future gains. So capital gains tax, slightly different timeline, 15th of December, slightly different rules around bed and breakfasting, where you can copper fasten certain gains and be tax-free, or copper fasten losses, which are offsettable in the future. One way or another, if you have capital gains tax in your world, you need to deal with it, and you need to deal with it before the 15th of December. Just to say to you finally on this subject, I said January to November. If you have bought assets and sold those assets in December, the tax is due on the following January the 31st. This is other than income tax, which is paid before you get the money, this is the quickest tax liability on the Irish statute books. So if you're involved in it, you need to understand what the rules are, and you need to use those rules to your best possible advantage. The final topic I want to give some attention to is EIIS. EIIS, an acronym that stands for Employment Investment Incentive Schemes. And as regular listeners will know, broadly these schemes are offered for investment in private equity in Irish either start-up or relatively new businesses. At a maximum, an investment in a qualifying EIIS scheme gives you 50% of the investment back as a tax rebate. So earlier I mentioned about increasing salaries for those of you who have the wherewithal to increase salaries. Doesn't necessarily mean increasing tax liabilities. Because if the salary is invested in EIIS, which again has to be done before the 31st of December, then the tax you pay in 2025 will be paid back to you in 2026. So there's a cash flow timing here where you have to part with the money before you get the tax break. But as long as you can handle that cash flow, then this makes economic or tax planning sense. The other thing to say, of course, about EIIS is they're relatively high risk. They're private equity. They're startup or relatively new businesses. So not everybody will have the stomach for the risks that this type of investment allows you to take on. But if you do have the stomach, then the tax breaks are phenomenal. And as I've cautioned people before, it's not just about doing it in 2025. It's about diversity, doing it over a number of years, putting EIIS exposure to different businesses. And for those of you of a nervous disposition, check out the funds. Because what a fund does, an EIIS fund, is it allows diversity, because you're investing in multiple businesses, not just one. It allows a professional fund manager to choose the investments based on the fact that they know something that we don't. And where these funds are concerned, often their remuneration for the fund manager is based predominantly on a success fee rather than an admin fee, which means that their goals are aligned with yours. They're not going to put companies into their fund that they don't think will be profitable. So EIIS is available, and it's available to all, but as I say, probably only usable by some. Are you one of them? To close off, let me say this. I've talked about pension funds. I've talked about EIIS. I've talked about tax loss harvesting. I've talked about, bed and breakfasting. And the point I want to make is that these are just tools. These are tools provided by the revenue and the state to allow us to keep our taxes to the bare minimum and to enjoy the rewards that we are due. I've quoted before the revenue, the last report I'm aware of that the revenue made to the PAC, the Public Accounts Committee, where it told the Public Accounts Committee, we as a nation underclaim tax allowances by 400 million a year. So the tools to make sure you're not one of those people underclaiming are the pension funds and the EIIS and the EVs and all of that. But tools are only as good as the craftsman who wields them. Anybody can sell you a tool. Anybody can sell you a pension or sell you an EIIS or sell you an electric vehicle. But only a truly impartial financial planner can teach you how to use those tools to your best possible advantage. It won't surprise regular listeners to know, or to hear me say, that planning is the key. Anybody can sell you the product, but only top-class planners can help you use those products to pay as little tax as legitimately possible and to keep as much of the wealth you're creating as possible, so that you and your family enjoy the fruits of your labour and enjoy the tax breaks you're entitled to claim. Good luck with your planning. Check off your list before Christmas. Be a Santa Claus. Check it twice. Do the planning. Do the work. And you will pay as little tax as legitimately possible. And if you do it properly, that'll be true in 2026 and every year beyond that too. It only remains for me to say thank you for listening today. For those of you listening on audio only, don't forget you can view these podcasts on video on YouTube. For those of you on YouTube only, don't forget we have other social media platforms like Instagram and TikTok and Facebook. There's a huge amount of content being put out there through Ask About Wealth. And if you're only getting that content through one source, dare I say it, check out the other sources. Because if you've learned something from this podcast, imagine what you might learn by looking at all our other outputs.